Hey, so there's an AI stock called Iron moving up like a straight line recently. And yeah, everyone's excited about its NVIDIA partnership, or maybe just any partnership that involved NVIDIA or OpenAI. Anyways, here's what you actually need to know before you chase this thing. Alright, if you're short on time or, not really interested in listening to some random guy on the internet talk about stocks, totally fair. Here's the bottom line. Iron has real infrastructure advantages and legitimate NVIDIA partnerships, but at current valuation the stock is priced for absolute perfection. The technical setup screams exhaustion, and the risk-reward right now heavily favors waiting for a pullback before considering entry. That's it. That's the takeaway. And welcome back to the channel. For those of you who are new here, and honestly most of you probably are since we're only about 3 months into this whole YouTube thing, I'm DataCat. I used to work as a data analyst inside a Fortune 50 company, spent my days buried in spreadsheets and coffee, living that corporate grind. Eventually I decided to trade the cubicle for, well, lasers and keyboards, I guess. I'm not here to brag or anything, no course selling here, but what I can do is break down data, dig into financials, and try to make sense of what's actually happening beneath all the hype. So if that sounds useful to you, go ahead and hit that subscribe button. It really does help a small channel like mine grow. Alright, so today we're talking about Iron, formerly known as Iris Energy, and this whole NVIDIA partnership situation that's been making the rounds. Now I know Iron might not be a household name like say Palantir or Tesla, but it's been absolutely ripping higher lately and is attracting more retail attention. I think it's worth understanding what's real, what's priced in, and where the risks actually sit. So let's start with the facts. Back in August, Iron announced that it secured NVIDIA Preferred Partner status. Now, what does that actually mean? Preferred Partner status essentially means Iron has demonstrated the scale, technical capability, and infrastructure readiness to deploy NVIDIA's most advanced GPU systems. It's a formal recognition that opens the door to better allocation of scarce, high-end chips. And in today's AI infrastructure world, access to supply is everything. Along with that announcement, Iron said it purchased 2,400 next-generation NVIDIA systems, expanding its total fleet to 10,900 NVIDIA GPUs. They financed $96 million of this through a 24-month lease, and they're building a 10-megawatt liquid-cooled facility at their Prince George campus, specifically to support over 4,500 GB300 systems. Now, why does liquid cooling matter? Well, just look at SMCI. Liquid cooling solution is becoming the standard for serious AI infrastructure, and the fact that Iron is building that capability in-house is a real technical edge. Then, in late September, Iron doubled down. They announced they doubled their AI cloud capacity to roughly 23,000 GPUs. This was a large mixed purchase. NVIDIA Blackwell architecture, AMD MI300 series accelerators, basically a modern stack suitable for both training and inference at scale. And they lifted their AI cloud revenue targets to over $500 million annualized by early 2026. This isn't coming out of nowhere, by the way. Back in 2024, Iron bought 1080 NVIDIA H200s and joined NVIDIA's Cloud Partner program. So, this has been a deliberate stage build-out over the past year and a half. So the partnership is formalized as NVIDIA Preferred Partner status plus sizable ongoing GPU procurement plus facility readiness for liquid cooling. It's real infrastructure, real capital deployment, and real technical capability. This isn't vaporware. Okay, so now that we know what happened, let's talk about what Iron actually is, because this company is kind of unusual, at least to me. Iron started life as a vertically integrated renewable-powered data center operator and one of the lowest-cost large-scale Bitcoin miners. And yeah, I know Bitcoin mining, some of you just rolled your eyes. But hear me out, because the infrastructure and power advantages they built for mining are exactly what make them interesting for AI. Iron runs a dual engine now. On one side you've got Bitcoin mining. They operate on 100% renewable power, hydro, wind, renewable energy credits, with very low power costs and large grid-connected power positions across North America. As of late 2024, They guided to illustrative all-in cash costs per Bitcoin mined of around $31,000 at 30 exahash per second. That's a meaningful energy advantage in a business where power is the single biggest variable cost. On the other side, you've got AI cloud and AI data centers. And remember, IREN develops, owns, and operates its own sites and electrical infrastructure. That means they can retrofit facilities faster, like adding liquid cooling. They have lower operating expenses and they can manage load flexibly. If Bitcoin prices tank, they can shift power to AI workloads. If AI demand softens, they can mine more Bitcoin. That optionality is valuable. And there are recent signals of commercial traction. IREN disclosed new multi-year AI cloud contracts, and on October 7th, they announced a proposed convertible notes offering to fund expansion. So they're raising capital, they're signing contracts, and they're building out capacity. On paper, this looks like a company executing a real pivot into AI infrastructure. Alright, so before we get into the numbers, we need to talk about the elephant in the room, the AI capital expenditure supercycle, and the growing concerns around circular financing. The AI capex boom is massive and increasingly concentrated, and several credible outlets, Reuters, Fortune, Bloomberg, CNBC, Morgan Stanley, have started flagging what they call circular or vendor finance deals among players like OpenAI, NVIDIA, AMD, Oracle, and emerging neoclouds. What does that mean? Essentially, it's when a vendor, say NVIDIA, helps finance a customer's purchase of NVIDIA chips, and that customer then uses those chips to build services that generate revenue, some of which flows back to NVIDIA or its ecosystem partners. It's not illegal, it's not necessarily bad, but it can overstate true end demand and propagate systemic risk if returns disappoint. Reuters described it as a classic prisoner's dilemma. Everyone's investing trillions into AI infrastructure because they're afraid of being left behind, even if the economics are thin. And again, there are echoes of the dot-com era here: vendor financing, round-tripping, inflated revenue recognition. Now, while the concerns are there, I would treat these as very early signals rather than jumping into conclusion at this stage. Plus, IREN isn't directly implicated in any of this. But the implication is indeed clear. Returns on AI compute capacity will hinge on sustained non-circular customer demand and high utilization. If the broader AI capex cycle peaks, or if utilization disappoints sector-wide, companies like IREN, who are betting big on AI infrastructure, will feel it and get hit the most rather than those hyperscalers. So keep that in the back of your mind as we look at the financials. Alright, let's dig into the numbers. I'm using IREN's quarterly data through their last earnings. Too many numbers. I know, I will try to use the visual aid here. Please bear with me. First, about its growth story. The revenue momentum is legit. You can see on the screen, trailing 12 months hit $501 million, with a strong year-over-year growth in the latest quarter. The sequential ramp has been sharp and consistent. So yeah, they're scaling fast, and the demand for their infrastructure is clearly there. Then here's where things get weird. Look at that gross margin chart. It's all over the place, swinging from 95% down to 24% in a single quarter. That's a massive drop, driven by a cost spike that basically came out of nowhere. This could be energy costs, depreciation from all that new equipment, or maybe a shift in revenue mix as AI cloud ramps up. Either way, it's volatile, and that's one red flag. What about the good news? Well, liquidity is strong. $564 million in cash, current ratio over 4 times. They're not in any near-term trouble. But debt has jumped to over $900 million, which is manageable, but only if margins stabilize and utilization ramps as planned. If demand softens or costs stay elevated, that leverage becomes a huge problem. This is a capital-intensive business. Property, plant, and equipment is now almost $2 billion. That's 2/3 of total assets. And to fund all this build-out, they've been issuing equity. Share count is up to 275 million from 189 million a year ago. That's meaningful dilution. So yes, they're growing, but existing shareholders are getting diluted in the process. So here's what matters going forward. 1. Can they sustain this revenue growth with real, recurring contracts? 2. Do gross margins stabilize, and what's the actual split between Bitcoin mining and AI cloud revenue? 3. Does utilization ramp enough to justify the leverage and the capex? And 4. How much more dilution is coming? The financials show a company in rapid growth mode, but with volatile margins, rising leverage and dilution. It's not a clean story yet, it's messy, it's high risk, and it requires flawless execution to work. And that's the fundamental picture. Now let's talk technicals, because this is where things get really interesting. And by interesting, I mean concerning if you're thinking about buying right now. IREN's chart is a parabolic move meeting rich valuation. Let me walk you through the setup. RSI is at 80, MFI is at 72. Both have been overbought for 10 straight days. RSI peaked at 84 on October 7th, and when RSI stays at high level for extended periods, it's a sign that momentum is stretched and a pullback is likely. The stock is 32% above its 20-day EMA, 96% above its 50-day, and roughly 3 times above its 200-day SMA. That is an extreme extension. Historically, moves like this are unsustainable, and IREN is currently only 5% away from its all-time high at $63.40. On October 8th, we saw an inside day with a doji candlestick and a gap and fade along with a volume spike. That's a classic exhaustion signal after a parabolic run. It suggests indecision and potential distribution, meaning smart money might be taking profits. The ATR is 8.5% of the stock price. That means a single ATR move down would take the stock down to $54. In simple terms, volatility is high, not for the faint of hearts. The flip side is the golden cross happened 65 days ago, so the trend is still intact but it's stretched. So the upside is that 5.5% to the 52-week high. Trend channel upper bound is around $81, which is a 35% gain. But this is a huge but. RSI and MFI suggest limited near-term room. Then there's the downside. The 20-day EMA is at $45, which is a 24% drop. The 50-day SMA is at $31, a 50% drop. Basically, what I'm trying to say is that the risk-reward ratio here is about 0.04. That's unfavorable for new longs. You're risking a lot more than you stand to gain in the near term. Now let's talk valuation, because this is where the rubber meets the road. At the current price, IREN is trading at 34 times sales and 84 times EBITDA. Let me put that in context. Peers in the data center and mining space typically trade at 5 to 15 times EBITDA. Even high-growth cloud infrastructure companies rarely sustain valuations above 50 times EBITDA. It seems to me that REN is being priced like a high-growth SaaS company, not a capital-intensive infrastructure play. The NVIDIA partnership narrative has driven a speculative premium. And look, I get it. NVIDIA is the hottest name in tech right now, and any company that can credibly claim a partnership with them gets a halo effect. But here's the thing. At current valuation, the market is assuming flawless execution we just mentioned, and the broader AI capex cycle doesn't stumble. Any miss on any of those fronts triggers sharp repricing. So let's zoom out for a second and talk about the broader AI infrastructure narrative again, because IREN doesn't exist in a vacuum. We're in the middle of an AI capex supercycle. Trillions of dollars are being poured into GPUs, data centers, power infrastructure, networking, all to support the next generation of AI models and applications. And a lot of that spending is being driven by fear of missing out. IREN is a high beta play on this cycle. The stock is trading on narrative, NVIDIA partnership, GPU capacity, renewable power, more than on current fundamentals. And that's fine in a bull market, but it's risky when the cycle turns. Now, again, I'm not saying the AI bubble is popping right now. I'm not saying IREN is a meme company with no substance. They clearly have real infrastructure, real partnerships, and real technical advantages, but the valuation assumes perfection, and the technical setup suggests the easy money has been made. So here's my take. If you're long IREN right now, consider locking in some gains. You've had a great run. Don't let greed turn a winner into a loser. And if you're watching from the sidelines and thinking about getting in, be patient. Wait for a technical reset. A pullback to the 20-day EMA at $45, or better yet, the 50-day SMA at $31, would offer a much better entry. The current setup is late-stage momentum. Watch for catalysts. The next earnings report will be critical. You want to see revenue mix, how much is Bitcoin versus AI cloud, margin guidance, contract details, utilization rates, and customer concentration. That will validate or deflate the narrative, and keep an eye on the broader AI infrastructure sector. If there's a sell-off in names like NVIDIA, AMD, or the hyperscalers, IREN won't be immune. I think IREN has a real edge. The renewable power advantage, the vertical integration, the liquid cooling capability, those are not easy to replicate, but edges don't matter if you overpay. And right now the market is pricing in a best case scenario. So my recommendation, patience. Let the stock come back to you. Let the fundamentals catch up to the valuation. And if you do decide to get in, size your position appropriately, because this is a volatile high beta name. Alright, that's all for today. If you found this breakdown useful, please hit that like button. It really does help the algorithm push this video to more people. And if you're new here, consider subscribing. Like I said in the beginning, this channel is pretty new, and I'm just trying to provide honest, data-driven analysis without the hype or the clickbait. No fluff, no nonsense, just the numbers and what they actually mean. Drop a comment below if you have thoughts on IREN, if you disagree with my take, or if there's another stock you'd like me to cover. I read every comment, and I genuinely appreciate the engagement. And hey, if you're a cat person, you probably already know, we cats are patient hunters. We don't chase every shiny thing that moves. We wait, we watch, and we pounce when the odds are in our favor. Maybe take a page out of that playbook with IREN. Alright, I'll see you in the next one. DataCat out, stay safe, and stay sharp out there.